Are you constantly faced getting stopped out, and while you correctly identified the daily bias? In this example here, we have a bearish structure in the overall higher time frame, and here we can see this tap into the higher time frame key interest point, which is the 4-hour fair value gap, and we can also see in the 1-hour fair value gap is also aligned with the 4-hour fair value gap. But when we zoom down into 5 minutes in the lower time frame, we can see we enter once there is a liquidity sweep, and then once we enter, we get stopped out. And then just to see the price continue our way at a later point. So in this video, I'll quickly address how to avoid getting into a trade too early and how to increase your accuracy just by 3 simple steps. Now let's dive in and break down the reason why you keep getting stopped out even though you correctly identified higher time frame, and then by end of this video, just applying by these 3 simple steps, it will increase your accuracy and avoid entering too early into a trade. So this is the most common mistake I see within beginner trader, and also trader who just recently found an edge or have an edge but are not taking this into account. So one thing is you are correctly identified the higher time frame. So either new high or new low, and then also the liquidity sweep. So in this case, where we can see in this example that I have shown here, we can see we have correctly identified the 4-hour higher time frame. And if you zoom down to 1 hour, it will also align in this area, which typically these will be our point of interest, right? This will be our point of interest that we want to see some sort of reaction here. And typically in here, most traders will wait for some sort of liquidity sweep. So we will look for equal highs. So in this case, these are the equal highs that we got swept. And then we want to see there is a bear flag that it got broken. And then this is where trader will enter here most of the case, and then expecting the price to continue down and then our stop at this recent high. But just to see the price go right into it and tap into it, stop you out, and then watching the trade continue lower once it grabbed these additional liquidity. So one thing to highlight here, just having correctly identified liquidity sweep does not automatically equal a reversal. That's something you need to know. It does not mean there is a confirmation, even though there is structure of some sort of bear flag under the lower time frame. You need to let the smart money confirmation to step in. What that means is you need to let the smart money to show their hand first, to actually show there's some sort of confirmation that already they entered the trade, and then you enter as a retail trader. We don't have the edge to guess. We only have the edge to react. We don't predict, we only react. So we want to wait for the smart money or institution to show their hand first, and that's where the confirmation come in. And once confirmation is in, then we know there's a momentum on downshifting lower, and then where we can correctly identify our stop loss at the recent high or the recent low. Okay, if not, most of the time you will become their liquidity. You will be the liquidity for, in this case, we'll go back up and then grabbing those additional generated high. Okay, now jump right into 3 steps, 3 simple steps I use to correctly identify when I should be entering, right? And that 3 simple steps, essentially just waiting for liquidity sweep to occur, does not mean, as we mentioned before, that there's a confirmation of reversal. So in the previously, once the liquidity is grabbed here, there is a bear flag. It does not mean there is a confirmation to go lower. What we want to wait for is some sort of market structure shift. So in this case, you need to break these recent low or some sort of change in state of delivery. Okay, market structure shift typically is more conservative. You will leverage the whole body of the candle and also the wick itself. For change in state of delivery, in this case, you will be just using the wick here. The body here. But for the market structure shift, you will include the whole wick, so it will be right down here. So the difference is, one is more aggressive, you enter early, but there's a higher chance that you might get fake out for changes to delivery. For option B, option A is typically the one I mostly use, is including both the body and wick, which is more conservative. You might get a later entry, but you have at least for confirmation that there is a shift of structure. So in this case, the shift of structure is from going from bullish to change from going bearish over here, right? So once there's a market structure shift over here, so let me erase all of this. Once there is a market structure shift confirmed in this area, what we can see, all these candles down here is a confirmation there is a market structure shift. So if you shift to, this is 5-minute chart, if you switch to 15 minutes or 30 minutes, this will be one single candle, right? This will be one single candle. And then this candle will be something like this. It will have a candle close outside of this candle. So let me clean this up a little bit. So you will have, let's say, all this candle down here, up here is a up candle, and then you will have a red candle down here. So you can see the market structure shift will happen right here. The body of itself will close outside of this candle. So if you go up to 15 minutes, 30 minutes, this is what you will see representing in two candle. This is 5 minutes. So in 30 minutes, this is most likely what you'll see. Candle just accumulating, and then you have a liquidity sweep up here, and then market structure shift. So once the market structure shift or changes state of delivery, whichever option you use, that there is a confirmation of the structure momentum is shifting to the bearish side. So once the shift, typically I will leverage into either OTE, which is one of my favorite tools to use. In this case, I did use OTE, and you can see it tap into here and also align with this generated high to sweep this liquidity, and then it just dumped, right? So this gives you precise entry, and then you have a clear defined stop loss at the top, and then your target will be at this recent low, or for 2R, or in this case down here there was a significant low aligning up with low volume nodes. For volume profile, that's on a separate video. If you're interested, you can take a look how I leverage that into my target and also entry as well. But in this case, this is clear and simple, where your entry leveraging once there's market structure shift for changing state of delivery, there is a shift of momentum from going bullish into bearish, right? This alone is something that you need to start playing around with and also start adjusting your eyes to look for, not just only looking for one thing, which is the higher time frame is very important. With the higher time frame, there's no point to looking any of this, which is great that you already mastered this part, but this part is not enough, right? After higher time frame, the liquidity sweep, these two alone does not give confirmation that it's ready for a move lower. Yes, you can enter here, and then your stop can put, let's say, outside the higher time frame box area with a point of interest, but this zone is way too high for your risk. Your risk essentially is double, more than double itself. So you have one, and then you have double. This itself is increase your odds of winning, but also at the same time, your R and R will decrease, right? So your R multiple will suffer from this if you put it out here. And there are times where you will never get a market structure shift, right? So there are times where prices go down, up, chop around, grab more liquidity, grab lower liquidity. Does not mean market structure shift if body doesn't close out in the higher time frame, and then just go higher and then continue higher, right? So there are cases this does not even cover. So it's very important for you to understand market structure shift tying along with liquidity sweep and higher time frame will give you an edge on confirmation where the smart money stepping in with momentum shifting to the other directions. And that's the true reversal. Okay, now let's dive into the live chart. Now let's dive into an example here where we'll leverage the criteria only using liquidity sweep and also higher time frame point of interest, and how we can use market structure to avoid those stop loss. So here we can see there's a clear bullish structure going up. And then there we identify in the 4-hour, currently looking at the 4-hour chart, there is a fair value gap as a key of interest, and also aligning with 1 hour as well. Now we zoom into 5-minute chart, so we can see the price reactive into this key zone here, and it is respecting it. So what we want to look is for some sort of liquidity sweep, and then for a long entry. So what we want to see is this low relative key liquidity low to get a sweep, and then for a entry long. So here we get a sweep, and now we look for a long entry. and then stop at its low, and then target its high. So if we look into 1 minute, right, you can also see there is a inversions that most of trader will use for inversions. I'll keep it here in a different color, and you can enter it off this inversions as well. Candle close outside of this inversion box, so that's a valid entry. Now we want to look for continuation upwards, and we can see it did not respect, and then continue with move lower. And let's say we move our entry into down here for these liquidity sweep, and then same thing, we'll look for a lower time frame, zoom in again for some entry at these high. Okay, so we can enter from here, right? There is a fair value inversion, fair value gap as well. Let me close this out. And we can see the price continue to move lower. And even though we put it outside here as a stop outside the fair value gap, you can see the price tap us out. Okay, so let me zoom into the 5 minutes so you can kind of look. It did go up when we enter, so give us some hope, and then it died out, right? And then if we continue to take another trade, it will stop us even further because it continue lower and close outside this fair value gap. But if you take a look in the 1 hour and 4 hours, right, in the 4 hour time frame, no candle actually closed outside of it, so this key zone is technically still valid. But when you look at 5 minutes, right, it does close out of it. So how do we avoid this? This is where we tie it into market structure shift for some word changes state delivery, for some sort of momentum shift, a confirmation from institution buyer pressure to come in on the buy side. Here we can see these are the key high. This is where the zone that if we want for look for key entry. So in this case, if the liquidity sweep happened over here, you want to see some sort of market structure close outside of this key high. So even these key highs. So ideally, I would want it to close outside of sweep here, close outside here, and then go down lower and then continue higher. That would be my ideal trade. So in this case, there's no trade here, no trade here, no trade here, no trade here. Now we want to look for some sort of market structure shift, which we do get here. There's a clear shift in market structure in the 5 minutes. Okay, now we look for a entry long. Stop outside here. And then our target will be at this recent high, right? So we can take a look in the 2 minutes. We got tapped in, and here we go. It moved very efficiently, right? Move very efficiently to our target to the T. And why does it do that? Because when the buying pressure is you're on the right side, the price will be efficient. It should not stagger like this, accumulating. This essentially is just a huge accumulation zone that go lower and lower and lower. You want to look for these key break. So currently looking at 2 minutes, this key high needs to break if it should shift once liquidity is grabbed here. So let me move this. This liquidity once it's grabbed, and of course this is grabbed outside of the fair value gap. But if you look into the 4 hour chart, the no body will be close outside of this. So this is accurate market structure shift. Here will be your entry. You target the recent high, and then the stop loss will be at this low or even at this relative low. This should not move down towards here at all, right? So with this in mind, hopefully this will help you to avoid getting stop out if you're facing issue where you are correctly identifying the higher time frame and also the daily bias, but you're just too early to the party. When you're too early to the party, that means the player hasn't come into play yet, right? You're too early. So you want to wait until the big players show your hand first, and then you ride the momentum. When you know you're on the right side, the momentum will look like this. The price will be very efficient. It will move fast. It should not stagger or accumulate side on the sideway. And this, if you're in a trade and then it's sideways for this long without any clear market structure break, then you probably should close out your position and wait for a clear confirmation. hopefully this is helpful, and this hopefully will increase your entry more accurately and also be more patient on what you're looking for and increase your accuracy as well. Stay safe and happy trading.